Greetings, family. This is Miles from Milestone Investing. This is an article from City AM, Friday, the 12th of October. The headline starts with risk off. The FTSE100 drops to a 6-month low as investors across the world flee to safe haven assets. The article continues. A global equity bloodbath plunged the FTSE100 to its lowest level in 6 months yesterday on a gut-churning day for investors. The sell-off began in the US on Wednesday before spreading to Europe, Asia, and trading floors around the world. Global growth concerns, the prospect of higher US interest rates, as well as the ongoing trade war between the US and China combined to send stocks tumbling. The UK blue chip index closed almost 2% down, dropping to its lowest level since April and wiping £36 billion off the value of its companies over the course of the day. The Dow Jones initially led the downward charge, losing more than 830 points, 3.2% on Wednesday, and continuing to slide yesterday, losing a further 545 points. Donald Trump took a swipe at Federal Reserve Chairman Jerome Powell, saying the Fed had gone crazy by raising rates, which it has done 3 times this year. The bloodbath for global equities comes as investors adjusted to a world of higher US interest rates, said Jasper Lawler, the London Capital Group. Lawler said investors were switching bets on growth stocks such as Facebook and Amazon to more conservative strategies. European markets suffered heavy losses, with the Eurozone stocks index comprising companies from 12 countries down 1.7%. The FTSE All-World Index of 3,100 companies across 47 countries fell 1.28%. Interesting article. As you guys know, I've got an accounting background, and so we accountants, we're trained to kind of look at the world from a fundamental perspective. You've got fundamental analysis, looking at profit and losses, looking at what the business actually makes, and then you've got technical analysis, which traders look at to identify really the supply and demand of which companies are really in vogue, which ones are not. I come from the accounting area, so I try to look at valuation. Are valuations real? Are they sustainable? So in light of that, I want to pick on 2 companies recently declared themselves to have a $1 trillion valuation, a $1 trillion valuation. So these 2 companies was Apple and Amazon. So I want to just look at their valuations and see what I can make of it. So I took these numbers for the recent data on both Apple and Amazon. Now, because they're American companies, they report their numbers quarterly. So Q1 for Apple, the last numbers they released, they reported that they had $88.3 billion in revenue. And that resulted in $20.1 billion in profit. Profit margin, 23%. In other words, for every $100 that they sell in goods, $23 drops down to the profit line. That's what 23% profit margin is telling us. If you annualize those numbers, 88 becomes 353 and 20 becomes 80. So let's go to this $1 trillion valuation that we spoke about. So if you take $1 trillion, which is 1 with 12 zeros following it, if you take $1 trillion and you divide it by their profits, okay? Now, why the profits? Because that's the number I've got available to me. Earnings is a slight adjustment on those profits, but I'm not going to do that adjustment here. I'm just going to take the raw numbers of profits, and I'm going to get a rough P ratio. And so if I take a valuation of $1 trillion and I divide it by the profits, 80.4 billion, I get a number of 12.4. The way I like to look at the number of 12.4 to make it make sense to me, if I take number 100 and I divide it by 12.4, I'm going to get a number equivalent to 8%. And so a P ratio of 12 is like an 8% return on investment. I then compared those numbers to Amazon. And so, as you know, the valuation P ratio is based on the profit, so I don't need to look at revenue. And so I'm going to take the profits of Amazon, 2.5 billion. Annualize that, 10 billion. If I divide the valuation by the profits to get the P ratio, I get a number of 100. And again, let's do the same thing. What does 100 mean? Well, if I take 100 and I divide it by 100, I get 1. That's like 1% return on investment. And so you can see, if Apple is offering you 8% and Amazon's offering you 1%, where are you going to put your money? We can see that Apple basically is the better value for money out of those two particular companies. Let's say only these two companies exist. With this model going on here, money would fly from Amazon and go to Apple. I'm not saying Apple is a safe haven company, by the way, but I'm just saying, just in this particular model. And so I would say to you that the Amazon valuation of $1 trillion is frothy. It's frothy. It's not sustainable. It's not going to stay there. For it to stay there, they need to make more money. Their profits need to go up significantly, okay? Like their neighbors across the spreadsheet in Apple. Apple's numbers with a P ratio of 12, that is reasonable. That is sustainable. As long as they can maintain their business model, that is sustainable. That's real. So, in light of all of what I just said to you, some of you want to actually just find good assets and just plant your money there and let them just feed you dividends year in, year out for a very, very long period of time. And I'm saying to you, the P ratio is one of the ways to establish whether or not a company's valuation is too high, too low, or about right. If a P ratio was something like 2 or 3, that's too cheap. And if Apple was 2 or 3 valuation, because let's say the share prices drop massively, I would buy that all day long. So just letting you know, if you ever see Apple trading at a P ratio of 2 or 3, sell your house and buy Apple, because it's going to bounce up. If these profits stay the same, they're going to bounce up. Amazon, with a P ratio of 100 and going on, this is a number that can't sustain itself, and maybe you might want to short this particular company. When you see that, this P ratio indicator is an indicator of value. Are these numbers real? Is the valuation real? And is it sustainable? So if I was looking at this, I would say Apple is about right, but I'd be shorting Amazon. And if I saw Apple at 2 or 3, I'm going long on Apple all day long. If the P ratio was 2 or 3 or 4, I'm going long all day long. So just letting you know, 8% valuation of 12, I think is a good number, and it's about right. But if it gets much cheaper than that, it goes on the list to buy all day long. Amazon is too frothy, and that needs shorting. Now, I'm not telling you to short Amazon, by the way. I'm not telling you to go long on an Apple. I'm merely telling you what would be a sensible thing to do based on the scenario I just painted for you. I certainly hope that you found this particular insight useful. This is Miles from Milestone Investing. Happy investing.